Retirement is a significant milestone in life, and careful financial planning can make all the difference in ensuring a happy and worry-free retirement. Whether you're just starting your career or are already on the path to retirement, incorporating sound investment strategies is essential. In this video, we'll explore 5 key tips to help you build a secure financial future for a joyous retirement. Planning for a comfortable retirement is a long-term process that ideally lasts a lifetime. Today, a healthy adult might spend nearly 1/3 of their life in retirement, and for some fortunate individuals, perhaps even longer. Many of us are so preoccupied with our jobs that we often overlook the importance of preparing for the years when we won't be working. Proper retirement planning isn't something you can do just months before retiring. It isn't a last-minute endeavor. The sooner you start considering it, the better. And when it comes to financial planning, who better to learn from other than one of the most renowned investors of all time, Warren Buffett? Warren Buffett is an American business magnate and the current CEO of Berkshire Hathaway, a top global company. Even though he hasn't retired and might seem an unlikely source for retirement advice, his financial achievements are undeniable. He's accumulated over $100 billion in wealth, indicating that, if he wanted, he could have retired early, possibly in his 30s. So, if you're beginning or about to start your retirement planning, here are Warren Buffett's top investing tips to consider. Tip number 1. Have a purpose. Most Americans think of retirement as a time to stop working, relax, and gradually ease into the final chapter of their lives. However, Warren Buffett advocates a shift in this perspective. Instead of viewing retirement as a slowdown, Buffett suggests seeing it as a new exciting chapter in life. He claims that planning with this mindset can lead to a more rewarding retirement, giving one a sense of purpose. Buffett believes that without a goal, retirees could face health issues, reducing the quality and potentially shortening the length of their retired life. Buffett's own life exemplifies this viewpoint. Instead of retiring traditionally after age 65, he continues to lead one of the world's most prominent companies even at age 92. Remarkably, despite his unconventional diet, filled with cheeseburgers, ice cream, and Coca-Cola cheese, anything else that's at thank you, he remains active. Tip number 2. Cash is not king. Warren Buffett's phrase, "cash is not king," suggests that holding a significant amount of cash or cash equivalents is not a wise long-term investment strategy. In other words, he advises against the idea that keeping a large portion of one's wealth in cash is a guaranteed way to preserve and grow that wealth over time. Buffett's stance is based on the fact that cash typically generates very little or no returns on investment, and its value can reduce over time due to inflation. Not having a primary source of income can understandably make some would-be retirees nervous about having their assets stored in anything other than the safety of cash. But Buffett believes this could be a mistake, especially if you want to live on your savings for up to several decades. Buffett points out that cash has never been a good long-term investment because it's rare to find a cash-based asset that appreciates significantly beyond the inflation rate. Instead of favoring cash, Buffett urges investors to consider other assets with the potential for growth, such as stocks, real estate, or other investments. They can outpace inflation and provide better returns over the long term. This deliberate allocation could determine whether you'll leave behind abundant resources or experience a decline in your savings before your life ends. And this leads us to the next valuable tip. Tip number 3. Invest in high assets. Buy a stock the way you would buy a house. Understand and like it such that you'd be content to own it in the absence of any market. I find immense value in this quote from Warren Buffett. Here's why. Usually, investors see buying stocks and buying property as very different investments. However, Buffett believes treating them with a similar mindset is beneficial. The most successful investors Buffett included purchased shares as a long-term investment, just as we buy our homes. Buffett himself still owns certain stocks he acquired back in the 1960s. If he kept changing his mind or bought and sold stocks quickly, he probably wouldn't be as successful as he is now. We would become better investors and likely accumulate more retirement funds if we adopted a similar approach. Buffett thinks that people often make investing more complicated than it is. As a result, he advises investors to strip away unnecessary complications and then focus on the basics. He suggests that for most people, a wise choice is to opt for low-cost index funding. This belief aligns with his well-known 9010 rule for investing. If you are not as experienced as Buffett, understanding his investing advice might be tricky to fully grasp it. Let's start with understanding an index fund. An index fund is a simple investment tool that tracks the performance of a specific group of companies. While you can't directly invest in an index, you can invest in a fund that mirrors its performance. These funds can be mutual funds or exchange-traded funds. Buffett recommends investing in an index fund that tracks the performance of the S&P 500. This index has the 500 largest publicly traded American companies. When the index goes up, so does the value of the fund. According to Buffett, a significant portion, about 90% of your retirement funds, should be allocated to index funds tied to stocks. Now, what about the remaining 10%? This is where Buffett recommends short-term government bonds. These bonds help fund various government projects and are considered safer than many other investments. While they offer lower interest rates, they also provide a degree of stability. What's more, these short-term bonds mature in less than 5 years, providing you with a reasonable level of liquidity. Lastly, adding bonds to your portfolio can help diversify your investments and manage overall risk. In market volatility, bond funds often outperform stock funds, offering a stabilizing effect. This suggestion goes hand in hand with the next piece of advice. Tip number 4. Eliminate fund fees. While investing, Warren Buffett strongly emphasizes the importance of reducing or avoiding high fees associated with investment funds, particularly mutual funds and exchange-traded funds. These charges, often termed expense ratios, management fees, or fund expenses, representative fees investors pay to the fund management company overseeing and managing the fund. High fees significantly eat into an investor's profits over time. Although these fees seem small individually, they can accumulate over the years and significantly limit the overall growth of an investment portfolio. That's why Buffett advises investors to be attentive to the fees associated with the funds they invest in and to prioritize funds with lower expense ratios. Because these fees directly affect the money you make from your investments, choosing lower fees enables you to retain more of your earned money. This leads to better long-term results and helps to strengthen your financial situation. Tip number 5. Don't get spooked by market crash. One of the biggest mistakes we can make in our investment journey is letting emotions guide our decisions, especially when planning for retirement. However, Buffett strongly advises against this approach. Why? Because he firmly believes that crashes are temporary, where selling your shares has permanent consequences. As I mentioned earlier, Buffett still retains ownership of some of the stocks he acquired in the 1960s, and these very stocks have contributed significantly to his billion-dollar net worth. Therefore, as an investor, the gravest mistake you can make for your future retirement is selling assets you've spent years investing in at significantly reduced prices merely due to fear. So don't let yourself fall into this trap and set your retirement plans back by decades. Market crashes will always occur. By mentally preparing for this inevitability before the next crash happens, your retirement savings will be better off and more secure. Building a secure financial future for a happy retirement requires a proactive and informed approach. By defining your goals, starting early, diversifying your portfolio, maximizing retirement accounts, staying informed, maintaining an emergency fund, and seeking professional advice when needed, you can pave the way for a fulfilling and stress-free retirement. Remember, the key is to be patient, stay consistent, and adapt your strategy as you progress through different stages of life. Your future self will thank you for the careful planning and thoughtful investments made today. Well, thank you for watching and staying with me until the end. If you have any comments or thoughts you would like to share, please do so in the comments section below. Until next time, have a great day.